Hello, everybody. Welcome to Monday. The S&P 500 was up 0.09% today, which is quite an accomplishment. Actually, it was down a fair amount, especially over the weekend. Moody's had announced that they were, reducing our top tier rating for the Treasury bonds down to the next tier. This has happened before. I remember, in 2011, we had a downturn. I think the market dropped about 6-7%, but came back pretty quickly. I think the market's learned that ratings they're important. I suppose even more important for the bond market because usually it ends up meaning that you have to pay more for your debt, and it does revolve around the key premise that I have that in order for us as a country to survive some of these big downturns that are going to come our way, just because they always happen, we have to have a strong treasury market that we can sell treasuries to others to support ourselves, to maybe do stimulus, those types of things, and even to be able to absorb losses in terms of people selling. So, for example, Japan is, I think, our largest foreign holder of our treasury bonds. If they run into problems during some big downturn, they might be selling treasuries. At the same time, we're trying to sell treasuries to support ourselves. So you do need, a strong bond market. And I thought what was interesting today, the total bond market index from Vanguard was only down 0.03% today, even with this downgrade. Although that index does incorporate, almost all types of bonds as far as that goes. It's not a straight up treasury piece, but nonetheless, we saw a pretty good recovery today come out of both the bond market and the stock market from where it opened up this morning. And I think part of that probably is because of the tax package that got pushed out of the committee today, basically, or this weekend. And it's, got a whole bunch of pieces in it. What they're trying to do is, go through this reconciliation process, and you're allowed to have some deficit, mainly because we already have some deficit. But they're projecting right now about a $3 to $4 trillion deficit over the next 10 years. I would guess, as I've seen for all of these reconciliation projects, they're pretty far off. I would bet it's going to be higher. Some of the things that they're offering as, tax cuts are temporary. They'll expire at the end of Trump's term. The tax on overtime, tax not going to give free tax for Social Security, but they're talking about a $4,000 additional deduction if you're over 65. And so there's a whole bunch of things in there that are, part of the campaign promises. So he's meeting the promise basically, but they would go away if they didn't go away. And that is one of the problems. Sometimes it's hard for these things to go away because somebody has to take responsibility for actually increasing the taxes back from where they were, just like the tax brackets we have right now are being extended in this package. They were supposed to be temporary up until the end of this year. And then you start to get into that kind of $6 to $7 trillion deficit over that 10-year period. So, we've got a ways to go here to try to figure this out and to try to find out what's going to happen with the bond market. I do think there'll be a fair amount of attention here placed on the bond market because of, I think that's the first place you might be able to see some of the things that are going on. So, we have these tariffs coming in. We haven't seen the impact of them yet. What will the impact be, right? How much will be absorbed by, say, foreign producers? How much will be absorbed by the companies like, say, Walmart, selling those goods? How much will be absorbed by the consumer? Somebody's going to pay those in some form across those three categories, broad categories. But and then what impact does that have on inflation and what the Federal Reserve might be doing? And then what impact does that have on, the overall concept of the economy itself, as far as that goes? So, that's why we're still kind of hanging back a little bit with some of our targets, just wanting to wait and see kind of some of these things and how they play out. I feel good. We're in there with our broad market pieces, what we call our core pieces. And I feel fine for where we're at the moment as far as that goes. I do feel the market has some pretty good momentum to the upside still. Today's a good example. I mean, even after a rating downgrade and what have you, and opening up lower, the market came back up and continued to go. So the primary direction here is definitely moving in the upwards position, and we're not at a new all-time high, and we are running into a whole bunch of overhead resistance here. If you look at the charts, the S&P 500, for example, spent a lot of time, at this same spot, and maybe, here and a couple hundred points above us, there was a lot of churning in that area as we were kind of hitting new all-time highs and getting through 6,000 and those types of things. So I do think we'll have a little bit of a challenge trying to get through into a new all-time high if that's where we're going to go as far as that goes. But anyway, that's what's happening today. Not a bad day for the stock market altogether, considering what's happening. We'll see what happens tomorrow. We'll talk to you then. Thank you.